They're selling Bitcoin ETFs in Hong Kong while jailing crypto traders 20 miles north in Shenzhen. Welcome to China's crypto paradox. One country, two completely opposing approaches. Beijing just reiterated that crypto trading is banned, but courts say that ownership is legal. Meanwhile, Hong Kong is courting crypto exchanges and launching institutional products. So, what gives? Well, the CCP has been toying with us like this for just too long. Today, we find out what they're playing at and if they will ever unleash Chinese retail investors on your bags again. My name is Louis, and you're watching The Coin Bureau. First things first though, none of this is financial advice. I'm just someone on the internet trying to make Chinese crypto policy make sense. Do your own research before making any investment decisions, especially ones based on geopolitical speculation. And if you're tired of waiting for China to pump your bags, then pump those like and subscribe buttons and that notification bell. So now, let's get into it. To understand China's crypto strategy, you need to know how one country, two systems actually works. This is the organizing principle that allows Beijing to pursue completely contradictory policies within its own borders. It was originally designed to integrate Hong Kong after the UK withdrew its tentacles in 1997, and now it's being creatively applied to manage the digital asset revolution. The framework is straightforward. Hong Kong maintains its own legal system, currency, and regulatory environment while remaining under Chinese sovereignty. The mainland, however, operates under socialist law with capital controls and the non-convertible renminbi. Hong Kong uses common law with an open capital account and freely convertible Hong Kong dollar, two operating systems running on the same sovereign hardware. For Beijing, this solves a major crypto dilemma. The government views decentralized crypto as a threat to monetary sovereignty and social stability, but completely disengaging from it means ceding technological and financial innovation to rivals. One country, two systems provides the solution. Build a digital Great Wall on the mainland while opening a Golden Gate in Hong Kong. Total prohibition on one side, controlled innovation on the other, all under one flag. It's a calculated strategy executed with clear intent. Understanding how the system operates explains how Beijing could have its cake and eat it too. For Beijing, crypto threatens their entire system of control. The government sees it as a social contagion that chips away at the existing political and monetary order. They've gone all out to neutralize this threat, building ideological and enforcement infrastructure just to keep crypto down in the dumps. The official narrative is unambiguous and deeply entrenched. State documents explicitly link cryptocurrency to, quote, illegal and criminal activities such as gambling, illegal fundraising, fraud, pyramid schemes, and money laundering. These activities, quote, disrupt the economic and financial order, and, quote, seriously endanger the property safety of the people. In Chinese political discourse, threats to economic order and people's property are threats to social stability, the paramount priority that legitimizes the CCP's power. This framing transforms crypto from a financial issue into a national security threat. Official media reinforces this constantly, running exposés on crypto scams, featuring victims who lost life savings, connecting digital assets to capital flight and economic sabotage. Academic institutions publish papers detailing crypto's threat to monetary sovereignty. The security narrative is state doctrine backed up by enforcement machinery that has serious teeth. The historic crypto restrictions imposed in 2021 established a permanent, quote, multi-agency coordinated enforcement mechanism designed to, quote, maintain a high-pressure crackdown. The People's Bank of China leads this coordination, but participation extends to virtually every branch of government. The Supreme People's Court provides judicial backing for prosecutions. The Supreme People's Procuratorate handles criminal cases. The Ministry of Public Security runs investigations and arrests. The State Administration for Market Regulation monitors businesses. Banking and insurance regulators police financial institutions. The Securities Regulator watches for crypto derivatives. The Foreign Exchange Administrator tracks cross-border flows. The Cyberspace Administration censors online activity. This machinery operates continuously, monitoring blockchain transactions, infiltrating OTC networks, prosecuting violators, and developing new detection technologies. Chinese courts prosecute hundreds of crypto-related cases annually. Courts across China have sentenced traders to lengthy prison terms for operating OTC networks, among other things. Authorities have arrested dozens in raids on underground banking operations, processing billions through crypto. In one major case, Sichuan police arrested 193 suspects in an operation that has moved $1.9 billion using crypto. To put things into perspective, Chinese courts handled over 7,400 crypto-related criminal cases between 2020 and 2022. The Ministry of Public Security's Card Disruption campaign, which targets crypto-enabled money laundering, has frozen hundreds of thousands of bank accounts suspected of crypto trading activity. The legal framework reflects this blanket approach. The progression from 2013's commodity classification to 2017's ICO ban to 2021's comprehensive prohibition escalated as crypto evolved from curiosity to threat. Yet, that legal paradox persists. Courts recognize crypto as property because it objectively meets legal requirements. It has value, scarcity, and can be controlled. A November 2024 Shanghai court ruling confirmed that, quote, simply holding virtual currency itself isn't illegal, but any contract to transact that property violates, quote, public order and good customs and is void. You're allowed to own something you can't buy, sell, or use. Courts will prosecute thieves who steal your Bitcoin while refusing to enforce any contracts that would let you acquire or dispose of it. This is a deliberate trap, acknowledging property rights to avoid dangerous precedents while ensuring those rights remain practically worthless. Now, cross the border into Hong Kong, and one country, two systems becomes apparent as it relates to crypto. The Special Administrative Region is building next-generation fintech infrastructure under careful state guidance. It's controlled experimentation. Hong Kong's transformation from crypto skepticism to active promotion was calculated. In October 2022, the government declared its vision to become a global virtual asset hub and set about building the regulatory architecture needed for institutional investors to participate. For now, local virtual asset service providers face requirements that exceed most global standards, including 5 million Hong Kong dollars in paid-up capital, 98% cold storage for client assets, comprehensive insurance, segregated trust structures, and extensive fitness assessments. The Securities and Futures Commission conducts rigorous inspections, demands real-time monitoring, and requires detailed reporting. Compliance costs millions annually. Bug for innovation, but a feature in that it ensures only serious players can enter. But let's look deeper at what Hong Kong is actually building. The government issued 800 million Hong Kong dollars worth of tokenized green bonds, which is more than can be said for most other countries flirting with blockchain adoption. Naturally, this means lower costs, faster settlement, and improved transparency compared to TradeFi rails. The Hong Kong Monetary Authority also operates stablecoin sandboxes, working with issuers to develop frameworks for responsible innovation. They're exploring the e-CNY, a retail CBDC that could revolutionize payments, for better or for worse. But crucially, unlike the Mainland's surveillance-focused e-CNY, Hong Kong is exploring privacy-preserving technologies and interoperability. And of course, Hong Kong has played a central role in Project Enbridge, the wholesale CBDC platform for cross-border payments. Working with China's Digital Currency Institute, Thailand, and the UAE, they're designing blockchain infrastructure that can replace SWIFT for international settlements. And if you want to learn about how that's going, you can check out our latest video about it, linked in the description. Now, by creating a compliant and attractive environment, Hong Kong ensures international crypto firms, venture capital, and skilled developers remain within China's sovereign orbit. This prevents brain drain and positions a Chinese city as a central node in the future digital economy. Meanwhile, the mainland remains insulated. Knowledge flows north, technical insights, regulatory lessons, operational data. But the capital stays blocked by the firewall. Beijing learns without risks, innovates without exposure. Now, It's China's CBDC that tells you everything about why crypto can't be allowed to take root in the mainland. The e-CNY gives Beijing total control over money, and crypto takes that control away. Every e-CNY transaction flows through central bank infrastructure, creating a financial panopticon. The system logs everything: amount, parties, time, location, purpose. They say the CBDC has controllable anonymity, but this guarantees only anonymity between counterparties. Users are never anonymous to the central bank, which has a complete, real-time, Eye of Sauron view on every transaction. The state sees all, using AI to analyze patterns, predict behavior, identify networks, and enable intervention. The strategic objectives are wide-ranging. Breaking the Alipay WeChat Pay private duopoly returns payment infrastructure to state control. No more tech billionaires controlling financial data on hundreds of millions of people. Programmable money enables a precision impossible with cash, expiring stimulus to force consumption, negative rates that can't be avoided, subsidies locked to approved users, real-time economic monitoring. It's every economist's dream and every libertarian's nightmare. Now, it's the international dimension of the program that carries the most weight, because the e-CNY challenges dollar hegemony through incremental steps. Tourist pilots in Hong Kong, trade settlement experiments, the mBridge wholesale platform. Each builds towards a future where China transacts globally without touching Western financial infrastructure. Private cryptocurrencies are the antithesis of the e-CNY. Bitcoin proves money can move without permission. Stablecoins enable dollar access outside the state channels. DeFi creates entire financial systems beyond oversight. Smart contracts execute automatically without the possibility of intervention. Every crypto transaction undermines the control architecture the e-CNY embodies. Now, Beijing's investment is irreversible at this point. Hundreds of millions of CBDC wallets have been created. Every major bank has integrated at enormous costs, and cities have already airdropped tens of millions of dollars worth of e-CNY through lotteries. Government payments are increasingly digital. International projects are establishing Chinese standards, and Xi Jinping's personal endorsement sealed its fate. Now, the e-CNY can coexist with Alipay and WeChat Pay, but Beijing just wants to break their data monopoly and bring payment infrastructure under closer state control. But crypto is different because it proves money can move without anyone's permission, and that is what undermines the entire control architecture that the government is building. But despite the relentless crackdown, mainland crypto activity continues underground. Chainalysis estimates China still accounts for significant crypto activity, ranking 20th globally in their 2024 adoption index. The persistence of this underground market, processing billions annually, shows the futility of absolute prohibition. Over-the-counter, or OTC networks, thrive through private dealers who facilitate large trades via encrypted messaging and trust networks. Peer-to-peer platforms connect buyers and sellers directly. Payments are laundered through popular apps with plausible deniability. Restaurant bills on Alipay, gift transfers on WeChat. The crypto moves to private wallets, while the fiat transactions look completely legitimate. And this infrastructure mutates constantly. Shut down one Telegram group, 3 others emerge within hours. WeChat conversations migrate to Signal. Physical meetings shift locations. Underground networks evolve faster than enforcement can adapt. It's asymmetric warfare where the state's massive resources face nimble, motivated opponents. Economic stress turbocharges trading volumes, with OTC and P2P activity spiking during property market crises. Banking scandals create stablecoin demand. Currency weakness against the dollar drives Bitcoin accumulation. Citizens are preserving wealth and preparing for capital flight rather than chasing moonshots. The scale remains significant despite the risks. Chinese language OTC desks process billions annually, despite being banned. Tethered USDT dominates these underground markets. WeChat groups with thousands of members coordinate trades using code words: U for USDT, Big Cake for Bitcoin, Aunt for Ethereum. By dismantling the legitimate industry, Beijing has created a vacuum filled by sophisticated criminal networks. The ban supercharged crypto laundering instead of eliminating it. Blockchain intelligence reveals massive Chinese language crypto laundering services providing infrastructure for global illicit actors. One network, Who1 Guarantee, has processed $49 billion in cryptocurrency since 2021. These platforms launder proceeds from pig butchering scams, fraud operations often run by trafficking victims forced to work in Southeast Asian labor camps. The prohibition created a more dangerous and professionalized criminal underworld instead of stopping illicit activity. Meanwhile, Hong Kong serves as a pressure valve. While mainland citizens can't legally access its services, complex structures create gray channels. Offshore companies, trust arrangements, and nominee directors obscure beneficial ownership. Hong Kong's massive transaction volume relative to its tiny population suggests that it serves as a hub for outside capital, with the mainland being the most logical source. The firewall leaks wherever determined money finds cracks, and money is very good at finding cracks. Now, every bull market resurrects speculation that China will see the error of its ways and come crawling back to crypto to make our bags great again. Understanding one country, two systems explains why this is pure hopium. The bifurcated structure is the permanent solution, not a transition. Financial stability underpins government legitimacy, as the social contract trades political freedom for economic prosperity. When that prosperity falters, like during the 2015 stock crash or the 2020's property market crash, the party's authority is at risk. And for Beijing, crypto's 24/7 volatility and copious leverage represents pure systemic risk. One crisis triggering social unrest could threaten the legitimacy of state power. Capital controls are critical infrastructure for the government, allowing it to keep domestic savings at home for state-directed investments and to prevent currency crises. Crypto obliterates these controls instantly. One Bitcoin transaction bypasses decades of financial architecture. For Beijing, that's quite a conundrum. The e-CNY is now too big to fail. Beijing has poured billions into its development, integrated it across every major bank, and Xi Jinping personally blessed the project. At this point, the digital yuan has to succeed, because failure would mean heads rolling at the highest levels. The security doctrine has taken root. 10 ministries coordinated to declare that crypto, quote, seriously endangers the property safety of the people. This message is consistently reinforced by outlets from Xinhua News Agency to the Ministry of State Security, published warnings associating crypto with Ponzi schemes, capital flight, and national security threats. Once you've mobilized the entire state apparatus around a narrative, you can't just say, oops, we were wrong. The Chinese political system, it doesn't work that way. But China hasn't opted out of crypto. Through Hong Kong, Beijing pursues controlled engagement on its own terms. The mainland stays relatively crypto-free, while Hong Kong experiments with ETFs, stablecoins, and tokenization. Beijing studies the technology, attracts capital, and maintains influence over global crypto standards, all while keeping the mainland's financial system completely insulated. The membrane stays selectively permeable, ideas pass through, and money stays blocked. And this structure will only deepen. Mainland enforcement will intensify as the e-CNY expands, moving from prohibition to active suppression through enhanced surveillance of crypto activity and aggressive pursuit of criminal prosecutions. This is the logical conclusion of the CBDC program, spelled out in official documents which detail how the state is perfecting its, quote, crypto asset monitoring technology to achieve, quote, full chain tracking. The involvement of the Supreme People's Court, the Supreme People's Procuratorate, and the Ministry of Public Security in the permanent enforcement mechanism confirms the state's focus on legal and criminal consequences. Meanwhile, Hong Kong will pursue its digital asset ambitions with new products and deeper institutional participation. The firewall between them and the mainland stays permanent, creating lasting arbitrage opportunities. Mainland wealth seeking crypto flows through Hong Kong's gates, and global firms wanting Chinese exposure accept Hong Kong's framework. Beijing extracts value from both directions while avoiding direct risks. So, if you're hoping that China will warm up to crypto, honestly, you should just forget it. You're only going to get your feelings hurt. The China unbans crypto catalyst is cooked. Hong Kong provides the only reliable interface. But it's no substitute for the mainland retail volumes of yore. The underground mainland market offers no investable thesis. It's pure gambling on when the next crackdown hits. We hate to say it, but the China crypto story ends with permanent separation. Through one country, two systems, Beijing gets everything that it wants: CBDC dominance at home, blockchain innovation in Hong Kong, and control everywhere. It's time to accept that the world's second largest economy treats crypto like a contagious disease on the mainland while running critical trials in Hong Kong. One country, two systems. Zero chances of Chinese retail pumping your bags ever again. Place your bets accordingly, but just not on China. And so if you were hoping that China's retail will come in and eventually pump your bags, and you now do enjoy watching your hopes and dreams get crushed, then you should just check out our report on how private equity is coming for your 401k next. Because if there's one thing worse than China not pumping your crypto bags, it's Wall Street actively draining your retirement accounts. And you can find that video right over there. Once again, I'm Lewis, signing off, and I'll see you in the next one.